You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.
Hickey used the phrase as they were discussing it, caught my ear, I wrote it down, the importance of decisions based on data rather than emotion. So it wouldn't be an OIC without at least attempting to get a little bit of insight out of the DC. From my standpoint, I think some of the most rational, some of the most reasoned sound bites that we've heard have come from the gentleman that's about to come up on the stage right now. Please join me in welcoming from the SEC, Mr. Gregg Berman. Thank you very much.
Thank you. Good morning. It's a pleasure for me to be here today, though I have to say when, excuse me, when BATS first called me and asked me to talk a little bit at an options conference on what my colleagues and I are doing at the SEC on market structure and data, I was a little nervous because a lot of the things that we've done so far have been more on the equity side than on the option side. So I thought a little bit about what am I going to talk today to a group of people who have expertise in options and try to tie it back to some of the work that we've been doing on the equity side. And I realized that, well, I gave a speech about 2 weeks ago in New York City on equity market structure. So I thought, well, let's be efficient here and see what I can pull from that speech and bring forward. So the nature of the speech was on the complexity and the speed of equity markets. So I started last week with complexity, and I talked a little bit about the fact that in the equity markets, there is a very significant concern by many market participants that somehow the markets are too complex. There's a complexity issue. And I thought maybe we can translate that into the options markets. But it dawned on me that the option markets have dealt with complexity for quite a long period of time. In fact, one of the things that I do at the SEC is I review rule filings with a number of my colleagues. And one of the rule filings that I tend to look at are for things called complex orders. So it would be somewhat ironic to consider the fact that there are orders, known as complex orders, to do complex things, and at the same time have a concern about complexity in the options market just for the sake of complexity. So I'm 0 for 1 on trying to translate that. The second thing that I talked about last week was cancellations. And there is a hyper-focus on the nature of cancellations in the equity markets, that once a quote is there, it should be there till the end of time, and withdrawing the quote somehow is problematic. And then I, again, realized that in the options markets, very, very few option quotes ever get hit. Cancellations are not only probable, but cancellations are extremely likely, as you have to continue, market makers have to continue to requote. That's something that is built into the options market structure. In fact, if we didn't see a lot of quote cancellations, that probably would be a problem. So that's 0 for 2 so far. So I thought, what else did we talk about 2 weeks ago? We talked about the interrelated nature of the equity markets in a way that people perhaps did not understand in the past few years. There are a lot of new products, exchange-traded products, that are very much a derivative type of product where the value of the exchange-traded product is derived from the value of an underlying something or other, a basket of stocks, a basket of commodities, et cetera. This creates linkages where something moves here and people have to requote here. And that's a new phenomenon in the equity markets. So let's see how well that translates to the options market, where every single option derives its underlying value from either an equity or a basket of equities. So in fact, that's the whole entire point of the options market. So that is not only not a new phenomenon, but it is sort of the definition of what an option is. So far I'm 0 for 3. So the last point that I talked about, I figured this will be it, I can use this one, I can pull it forward, is a lot of the data that we've done around dark pool trading and off-exchange trading in the equity markets. a speech on off-exchange trading in the options markets would be an extremely short speech. So I guess I was 0 for 4 on figuring out how to translate, and I was actually starting to despair that there'd really be anything for me to talk about today on the options side. And then I realized that there actually is a common thread that we can discuss this morning. And that is that everything that I talked about a few weeks ago in New York was based on data, objective analysis of data in the markets to try to better understand what's going on. And that's something I believe that translates directly into the options markets. Now, most people just sort of say, of course, data analysis, we should be doing that. That shouldn't be taken as a given. Not a lot of markets in the world, not even in finance, does the idea of doing objective data analysis work. So let me give you an example. We're all concerned about investor confidence. How do you actually measure investor confidence? You can take a survey. You can put out opinion polls and ask people, are they confident in the markets? Are they not confident in the market? And we can sort of track that. That's not very objective. It's extremely subjective. And more so, I think we all recognize that investor confidence directly rises and falls depending on what the Dow Jones Industrial Average does. Investor confidence seems to go up when that goes up, and it goes down when that goes down. So you'd sort of have to disentangle the difference between confidence in the market structure, which is, as a regulator, that's what we do control, and confidence in the markets themselves, which as a regulator is not something that we can control. In spite of what most people think, there is no dial at the SEC that says turn the Dow up and down. I have looked. There is nothing there, trust me. So it's actually an advantage, and it's a very important advantage that we do have in both the equity markets and the options markets, that they are highly amenable to data analysis. But not just any type of data analysis that actually informs on policy decisions and helps you make rational decisions instead of making primarily emotional decisions. So that's what I want to talk about this morning is data, how we use data at the SEC, what do we look for, why do we ask for it every single time? For anybody who's been on the phone with me over the past 2 years, I haven't ended a conversation that doesn't say, could you please show me some data on that? So I thought I'd give you a little bit of a demonstration of what is it that we actually look for and how we use that. Before I begin, most people are familiar with the way that the SEC traditionally collected information, and that's through the public comment process. So we put out notes, we put out comment letters, we put out requests for comments, and we get lots of comments and data back. January of 2010, we had a concept release on equity market structure. Lots and lots of thoughtful comments came back. Some came back with data. Most were conflicting. This person says if you do X, the entire world will fall apart, you must do Y. And another person shows 50 pages of charts and data that says if you do Y, the world will fall apart, you have to do X. Now, the comment process from the public is very, very important, but we can supplement that. And we can supplement that by doing our own analysis at the SEC, bringing things together and contributing back to the public these types of analysis, and then get comment back on them instead of always going in the other direction. We first realized this based on the analysis that we did in 2010 on the flash crash, when we realized we had to get a lot of new data. So I'm very proud to say that in October of 2013, the SEC launched a new website on market structure. And it is dedicated to doing analysis internally and then sharing that analysis in a variety of different interactive ways with the public. And we've tried to concentrate a lot of the analysis on data that actually can inform some of the deeper policy questions, as well as some of the really detailed pilots that people are considering now. So rather than just talk about this, I thought it'd be a lot more fun to just show you this. Is there anybody, just show of hands, anybody on the sales side who have done anything on the sales, talking to customers, talking to clients before? Or, so at least one. So I'm violating every possible, I used to be in sales in my previous life, never show something live, ever, ever, ever. So if this doesn't work, it's because it's actually real and it's live. There we go, so this came up. This is the SEC's market structure website. It brings together 3 complementary points of view on market structure using data. The first type of data that we collect, believe it or not, are analyses that other people have done. Now, why would we actually just sort of regurgitate another analysis that someone else has done? Well, it's actually a lot more complicated than that. Academics and various parties in the industry have been doing their own analysis using data and empirical methods for 7-8 years now, especially since after Reg NMS. And a lot of them, as I mentioned, are conflicting. They have different opinions on what the data really says. But they're always taken in isolation. So what we thought we'd do is we'd actually collect all the analyses that use data to draw conclusions and see if there are any patterns, if there are any themes, and if we can make sort of heads or tails about why some of the papers say one thing and some of the papers say something else. So if you go to our website, you will find under the Research and Analysis page, literature reviews. And we put out a number of literature reviews, one last year on fragmented nature of the markets and off-exchange trading, and one just recently on high-frequency trading that you can download and read for yourself. That brings together about 36 papers over the past 7 or so years on high-frequency trading. And we've done something that's very, very different that we've not seen done before. We organized the data and the papers by the type of data that's being used. It turns out that there's not a lot of data on high-frequency trading, but there is a common theme. A bunch of papers used one set of data. Another set of papers used a different set of data, and yet another set of papers used a third or a fourth set of data. So we can line things up and say, for the same data set, what are people saying? Now for this data set, what are people saying? And we talk about the data, and we explain why the data may or may not be capturing all high-frequency traders, why it may be including people who you wouldn't traditionally consider high-frequency traders. And from that emerges a bit of a pattern. Now, I didn't plan on speaking a lot about high-frequency trading, but just listening to the panel before and to the remarks at the beginning, I thought maybe I'd spend a little more time on that. The reason why I didn't plan on doing a lot on HFT is there really is not a lot of HFT, if any, in the equity options market. It is much more driven on the futures side, futures options, and especially on the equity side as well. But considering all the comments that we've had so far, I thought I'd spend a little bit of time just discussing some of the results of the paper. Forget about the definition of HFT. I have no idea how to define HFT. I really don't think it matters. What I like to look at is what are the characteristics. So there are basically 3 characteristics that we've seen in the use of, let's just say, automated algorithmic trading not designed to execute a large block or to acquire positions that one has a fundamental value. And we can split the world basically into 3 camps. There are those parties who basically were yesterday's manual market makers and are today's automated market makers, using algorithms, putting in quotes, canceling those quotes, using a variety of different feeds to figure out what the theoretical price is. That's a big portion of where a lot of the benefits come from automation. There, however, has been one structural change that I don't think a lot of people appreciate, is traditionally market makers were making a market based on the flow for what they were solely making a market in. So if you were making a market in these options, you looked at those options. In the equities markets, if you were making a market on IBM, you looked at IBM. And maybe once in a while, if you're on the floor, you'd look up and you'd see where the S&P was or the Dow Jones was. And you might adjust something, you might get a gut feel. Today, because we do have computers, market makers can simultaneously look at many, many, many other prices that help them determine what their empirical price is going to be or their theoretical prices. So instead of just looking at the push and ebb and flow of pressure on what they're making a market in, they may decide to be more aggressive or less aggressive based on something that's going on over there. Humans can't do that. They're not very good at looking at thousands of things at the same time. That's what computers do. And that's really been the transition from manual market making to automated market making. There's a second role for this type of automation, and a lot of that comes in for arbitrage. The more products, the more there is to arbitrage. So you wind up having lots of folks who, on one side, are posting quotes, and on the same side, are taking quotes aggressively. And as we heard in the last panel, that actually does happen a lot in the options market, because you may be posting quotes, and you're hedging immediately in the underlying. So there's a lot of both taking liquidity as well as providing liquidity. And then we have high-frequency traders, who I think fit more the definition of what most people think, at least in this room, maybe not in the press, of those who are primarily taking liquidity. And they're trading in the same way that people have always traded. either with momentum or counter trending, but they're mostly not providing any liquidity at all. They're going to take either on the option side, which is pretty rare to be primarily taking, but mostly on the future side or on the equity side. If you have never read a 55-page academic study filled with more Greek letters, more equations, and more graphs and charts, and you've never done that before, there's no reason to start now. You can simply come and you can get the cliff notes here, and you can learn everything about high-frequency trading from 30-some-odd papers that we've been able to digest and present back with a lot of those conclusions. One thing, final comment on the HFT side, that just to reflect some of the comments that were made both yesterday and this morning. There seems to be a linkage that people make in their minds between high-frequency trading and fragmented markets. And the fact that, well, you have to have all of this trading in order to keep the markets aligned. Well, I think you have to have that trading to keep products aligned, but I'm not sure if you need to have that type of trading just to keep the different market centers aligned. Probably does happen a bit, but is that the real reason why it happens? I actually think we can answer that question pretty definitively today. And the way we can answer that question is, let's go look at other markets that aren't security markets. And we actually have two extremes. You can look at the FX markets. FX markets, no trade through, no central regulation. In fact, it's hardly regulated at all. Many, many, many different market centers, not linked up. You don't have to get the best price. It's just whatever it is to get the yen-dollar cross. Depends on where you want to trade it. High-frequency trading, you bet. Tons of high-frequency trading. In fact, there's lots of articles that talk about the increased amount of high-frequency trading that's going on in automated trading in the FX market. So that's a market that has fragmentation, extreme amount of fragmentation, that has nothing at all to do with a Reg NMS or regulation. Now let's look all the way to the other side of the spectrum. CME, E-mini futures contract. Completely monolithic. One market, one price source, one feed, everybody's together. There's not even a definition of a formal market maker. So when the CFTC did the study of the flash crash, they said these are people who have characteristics of market makers, and these are people who have characteristics of high-frequency traders who don't seem to be, quote, making a market, but they don't have the same rules and concepts that we have on the security side. So completely monolithic, no fragmentation, same amount of high-frequency trading that exists in the equity markets and perhaps in some of the options markets. So there's a lot of causes for high-frequency trading. I don't think we can say that the cause is fragmented markets, because that does not explain why we see it on the FX side and why we see it so much on the future side as well. So enough about high-frequency trading. Again, you can download the paper and learn a whole bunch about it. What I wanted to spend some time is show you how we're collecting data, raw data, from the equity markets and the options markets, and making some conclusions on that. A couple of years ago, we created a system, we implemented a system called MIDAS. It's a Market Information Data Analytics System. To say, like all good acronyms, we made up the acronym first, and then we figured out what it meant after. We collect the proprietary feeds from each of the exchanges on the equity side. We also collect the consolidated tapes from both NICE and NASDAQ, and we collect the opera feed. So we have all of that data coming into the cloud on a daily basis, and we analyze it, and we consume it, and we produce a variety of different metrics. I'm going to take you through a couple of the ways that we're looking at the data and looking at those metrics to give you an idea of how we think about data analysis. One thing to point out is we are collecting the proprietary feeds. We are collecting that based on machines that are co-located at the exchanges themselves. So for those in the market who may be an attorney general, I don't know, but if someone out there thinks that regulators are very behind the times and can't keep up with market participants, and at the same time think that use of the proprietary feeds or use of co-locating is all but for the select elite that no one else has any access to and it's impossible to use, one of those statements has to be wrong. Those both can't be the same at the same time, true at the same time. We are collecting the prop feeds. Is it hard? Sure, it's hard, but we have like 6 people working on this, and we don't trade. So it's definitely doable. One can get this information. One can consume this information. I'm going to show you exactly how we do that. So every day, data comes in, and we produce a suite of metrics. And we take those metrics, and we compute them on a stock-by-stock basis, and then we summarize them, and we tally them up at the end of each quarter, and we put that back out onto the website. Now, the metrics that we chose were ones that we think helped inform people on what does the market really look like. Not what people think it looks like, but what does it actually really look like. And we did a lot to try to visualize that information. So we're very advanced. We even tell you your browser is not good enough. So here's a visualization. Data is updated every quarter. We started by backfilling for about a year. We now actually have 21 months. And we try to go back a quarter and forward a quarter every quarter. So we're basically adding 6 months of data each quarter. We computed a number of different metrics. The one that I think is the most fun tends to be the trade order volume ratio. We literally count the number of shares that are traded, every single share that's traded. And we count the number of orders by share that are posted in the equity side. And we divide the two. Very, very simple number. And you can see that for corporate stocks, number runs about 2.5%, 3%. Really hasn't done much in terms of going up or down over the last few years. Then we did the exact same thing for exchange-traded products. 0.3%, 0.4%. Factor of 10 difference in the ratio of the number of trades that you actually have per order. So we thought this is actually quite instructive, and spent a lot of time at a talk 2 weeks ago talking about exchange-traded products. A lot of this data is emotionally charged. People look at it, they get mad, they pound the table sometimes, say, no, can't be. It's got to be something different. So for today, I thought we would talk about something that was not going to be emotionally charged, especially for this room, to give you an idea of how we look at data that you might not have ever actually looked at before. One of the things that we get access to when we use the proprietary feeds for the equity exchanges is we see every trade, not just trades that are reported to the consolidated tape. Up until December 9th of last year, odd lots, which are trades of less than 100 shares, for almost all stocks is like an exception for Berkshire Hathaway. But for the majority of stocks, odd lot trades were not reported to the public tape. But they are on the proprietary feeds. So we wanted to see how many odd lots are there. How many things are being seen by certain participants, but not seen on the consolidated tape. So we did that. We counted them. And we can count them in a few different ways. You can count by the number, and you can also count by the number of shares. Now, it's sort of not fair to count by the number of shares because it's going to be share weighted. They are the small trades. So we wanted to count by the absolute number. And we can see, we plot this, and like a year ago or so, 19, 20%. 21%, 22%, really hasn't changed much, not much of a trend, but 22%, that's almost one out of 5, 1 out of 4 trades not being reported to the consolidated tape. All of those trades are for price discovery, help price discovery. No one is seeing them. So we thought it would be good to be able to see, is there a pattern? Are there certain types of stocks where there are more odd lots than other types of stocks, and what that would look like? So in addition to just plotting trends, we allow you to take any of the metrics and divide it up by a couple different things. You can divide it up by market cap, by turnover, by volatility. Here, let's split it by volatility. I don't know. Doesn't really seem all that much difference to me. If we do it by price, though, you start to see some interesting patterns. Here, we allow you to say, these are the lowest price stocks, all the way to the highest price stocks. And users can come in and they can say, I want to see the second highest price stocks, the third highest price stocks, the fourth is already there, the fifth, the sixth, seventh, eighth. So it gets pretty crowded. But what you see is that as you go to the 9th and 10th decile, these are the higher and higher price stocks, so the odd lot rates start to increase dramatically. Here we're in the mid-20s. Here, we're up to 30, 35%. That's Google, Apple, IBM. Those are up in that decile. That's 1 out of 3 trades where you don't get any price discovery. We can track this over time. So we can establish a baseline, and we can see, is this getting worse? Is it getting better? And even perhaps, what's the effect on the marketplace? This is why we collect data, to be able to demonstrate these types of things. Now, we started this particular odd lot trade analysis in the summer of last year, about a year ago, and we first published the results in October. What was interesting is about the same time we published the results, the tape plans came out and said, you know what, we're going to start putting odd lots on the tape. So we thought this could not have been made better for us, because everything that we do for the purpose of establishing a baseline is to be able to track things so we can see what changes if there's a change in the regulatory structure. So a while ago, when we first went live with this on October 9th, we'd had a piece on odd lots. So these little data highlights help users come in and quickly see something about the data with a little bit of a description. What's the analysis say? What the chart reveals? And then at the bottom, why this is of interest. And I don't know if you can read that, but some of the things that we talk about is this is of interest because it has a big effect on investor confidence, massive effect on investor confidence. 3 years ago, a number of academics and others came out with papers highlighting the fact that there's an enormous amount of odd lot trading in the market, and it's not being published. And that freaked investors out. Many articles were written saying, this is bad, 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 bad. Why is this bad? Because obviously, somebody is trading in a way that they are trying to avoid publishing to the tape. So this is a real concern around transparency. And there were articles written saying that this is like, it's cheating. People are trading in a way that they're shredding their orders. They're purposely doing something so you cannot see what they're doing. And everybody knows if you're hiding something, you obviously are doing something bad. So this was really a hit to investor confidence. So what we had put down here is we said, now that we sort of have an inkling that these trades are going to start getting reported on the tape, we can actually test that theory that has been out in the ether for quite a number of years. Because what would happen if you were a nefarious player and all of your trading strategy was based on the fact that I'm trading odd lots, no one can see them on the tape, that's why I do what I do, you would draw the conclusion that, well, if we took that hiddenness away and we put those trades on the tape, then you can't do that strategy anymore. Obviously, it doesn't work. So you would expect to see odd lot rates do that as soon as they started to go on the tape. Now, that was our idea, and that's why we wanted to collect this data, to see whether or not the theory that was spooking investors, is that really true, or is it just a myth? So we published that, and we weren't the only ones who came up with that theory. So here's an article that was published on December 9th, when hidden volume, what was called hidden volume, the odd lot trades, were for the first time published on the tape. And if you scroll to the bottom, very back, it says, Professor Harris said she would be closely watching to see if odd lot trades dropped off significantly after becoming exposed to the broader public. So it would be a sign that some traders were using the anonymity of small trades for an advantage. Exactly what people for the past few years have been very concerned about. This article was on December 9th. How many articles have come out since then to do with this topic? 0. No one followed up on this. We did. It takes a long time for us to process things because we're a very slow regulator. So we decided that what we would do, because we didn't want to just process things on the 9th, because who's to say what one day is, we said, let's wait until December 31st. And on December 31st, we will see what we can see. So December 31st comes, January 9th. So January 1st, the holiday, and we actually had a snow day where the agency was closed during one of those days. So about 5 working days after the end, we published a piece. And here's the results. This is stocks, and this is exchange traded products. And here we zoomed in, and here you can see stocks, exchange traded products. Here's December 9th. What happened on December 9th? What happened for the subsequent weeks? Nothing happened in the subsequent weeks and on December 9th. There's no change at all that we can see in odd lot rates after they were published. That's a profound finding. What that means is what's freaked people out for the last 3 years is wrong. So when I think about all the issues that we have today in investor confidence and all the issues that are being brought up, I'm trying to figure out, in 3 years from now, what are we going to look at and study and say, yeah, that wasn't really a worry at all? Versus what are we going to look at and say, that was a real worry, good thing we did something about it. So sometimes you use data to actually look going forward, but if you don't actually even look at data to try to resolve old issues, how are we going to ever use data to resolve new issues going forward? So we thought we're pretty proud of this finding. It has not gotten picked up by the press, but I think if you were an investor and you looked at this, you would say, next time I read something in a blog or a book, I may actually think a little twice about whether or not I should take all my money out of the options and stock market and bury it in a mattress, or maybe this is just a little bit of froth and I should do a little bit of homework. That's the point of what we're doing. That's why we bring data in, that's why we produce these analyses, and that's why we try to get the analysis back out to everybody. Of course, odd lot trades doesn't have a lot to do with the options markets. So how do we get back to the options markets from here? Well, one of the things that we're also looking at, back to the research page, is we get the depth of book. We can see all of the depth beyond the national best bid or offer. And we've just started to put pieces together that help you track where in the depth of book trades are actually occurring. Now, I'm not going to go through in this in detail, but I would urge everybody to go to the website and take a look at this. It's just 2 pages, 3 pages, talk about the depth of book. Why are we doing this? We're doing this because there's been an enormous amount of interest since the Jobs Act on tick pilot for equity markets. Market makers can't make enough money. They've stopped producing research. When they stop producing research, there are no IPOs. When there's no IPOs, people go out of business. When people go out of business, you have 8 million people unemployed. So you've got to change tick size. It's almost like that commercial that says, don't get cable. If you get cable, then this happens, and somehow you get attacked by a bear at the end. So this long chain of events, we had a roundtable on it. We brought people in from everywhere, and they said, tick pilot, say what you want about the impact on IPOs, but tick pilot equity markets probably sounds like a reasonable thing to at least give it a try. So we started thinking about a tick pilot. Before you do a pilot, you should figure out what is it that you're going to measure. And not what is it that you're going to measure after the pilot starts. What are you going to measure now, today, before the pilot starts, so that when you start the pilot, you're going to measure it again, and then you're going to compare. Did it go up? Did it go down? Did it stay the same? You could do all of that work before the pilot starts. So we've been spending a lot of time on depth of book to see where the liquidity is on the equity side, so that in whatever form the pilot ultimately takes for equities, we'll know exactly what we're supposed to be measuring. Because you can measure things regardless of what the nature of the pilot is. Now, for people on the options side, you've got to be smiling at this, because you're thinking, we've had a tick pilot since 2007. That's a really, really long pilot. That's a lot of flying while this thing is going on. And sort of, is there anything we can learn from the options market about pilots and how to conduct pilots and how to think about that we have on the equity side? So we've been doing a lot of work at the SEC over the past 3 or 4 months on trying to better understand what was the actual effect of going from nickels and dimes to pennies and nickels for a select group of options. This is tough to do. We do not today get the prop feeds that show depth of book, but we do get the opera feed. That's a lot of data. And I know that you all know that it's a lot of data because a lot of you actually consume that data. But remember, we're not consuming it to trade. I have to say it like over and over because our ethics people are, you're getting all this data. No, obviously we don't trade or anything like that. But we have to store it, and we have to run massive, massive patterns on that. So the analysis that we do is actually pretty vast. And even though the pilot is 7 years old now, we're not looking back 7 years to see, well, what happened before? And the reason is we don't have to. There is a perfect natural experiment that is occurring right now, even today, for the options penny pilot, which is that if you have an option that's priced at $2.95 and it's in the penny pilot, it has 1 cent minimum tick. That's right now at 10:20. 15 minutes from now, that $2.95 may become $3.05 because the underlying has moved. Nothing to do with the actual option itself, just the underlying moved. Underlying moves, now you're at 305. You go from penny to a nickel. We can watch that. We can watch the spreads change from a penny to a nickel and from a nickel to a penny. We can watch where the size changes. We can watch not just where the bid-ask is, but the distribution of the bid-ask. And we can actually observe the number of messages that change, number of messages per second. And when it goes back down below $3, what happens then? You can't get a better experiment. The trick is processing the data, doing a careful job, making sure we really understand what we're looking at. So we've been spending the past few months doing exactly that, looking at options in penny pilot that move up and move down, move up and move down. We also get a lot of good ideas from market participants. So a couple of participants pointed out that averages tend to, at best, obscure things, and sometimes actually they lie a bit, because no one is actually the average. People are above average, below average, et cetera. So we can't just look at averages. So one of the things that we've been doing just recently, saying you might actually have an option that you think wouldn't really benefit by having a penny tick, because it's priced out at 25, 30, 40 cent spread. But once in a while, it comes all the way in. But when it comes in, does it actually come into 10 cents, or does it come all the way down to a penny or two? Because there's a big difference. Because if it goes from 40 to 20 once in a while, then having a penny really doesn't do much. But if you can see that it goes from 40 all the way down to a penny once in a while, then you really want to understand, when does that happen? Why does that happen? And does that give investors a cheaper price than they otherwise would have gotten? Now, if it only happens a little bit, a few percent of the time, then at first you might say, well, what's the big deal? It only happens once in a blue moon. But as we know, most options don't trade a lot. So it could be the case that, yes, the spread narrows once in a blue moon, but that's when all the trading happens. So if that's when all the trading happens, it really doesn't matter if the spread is 40 cents 99% of the time, if that only accounts for a small amount of trading, and that all the trading happens when you're at a 1 or 2 cent tick. So using objective measures and looking at these patterns of data, you can actually reach some conclusions that would say, this set of stocks that are in the pilot seem to be benefiting by being in the pilot. This set of options that are in the pilot don't seem to be benefiting, and there might be some disadvantages that we can look at. More importantly, this other set that's not in the pilot, what about the set that's not in the pilot? There's also a natural experiment. You go from a dime to nickels when you cross $3. We can look at that. We can look at that today, and we can draw some conclusions to say, these stocks that go from dime to nickel, they actually would be, or these options on these stocks, they actually would be good candidates to be at a penny, because there are some patterns that look much closer to the ones that we see for the ones that are currently in the penny pilot. It's a lot of data. It's preliminary work, probably about halfway through, working on it for a number of months. I know a lot of people in the options industry have also been working on this, and hopefully at some point we will get together. Once we get the numbers out in exactly the same way that we're putting things on the website, we will put all of our research out and hopefully open it up to comments and get a lot of feedback from market participants. So that gives you at least hopefully a bit of a good idea of how we think about things, not just in the equity side, but also in the options markets themselves. I'm going to leave you with a few thoughts, mostly about pilots. When I think about a pilot, that seems to be like the method of operation right now. Everybody says, I have an idea, let's just do a pilot. You say, well, what is the purpose of a pilot? People say, well, I don't know what's going to happen. Let's just try it and see. I have no idea what that means. It's fine for you guys to try it and see. You run businesses. Market maker, an exchange, go out and try it and see. Convince your managers, your board, your business people, your money, go out and try it and see what happens. But from a regulatory standpoint, we can't just like go ahead and try and see. What would the data be? Let's do something and then we'll count the number of negative comment letters that we get from market participants and then we'll just tally them up. And if it's 13 negative comment letters, then we'll unwind the pilot. So you have to come up with something before you start the pilot and figure out what is it that you're going to measure. Now, that's not easy. In fact, it's extremely difficult to do that. And I know that for many people in the industry and certain people in this room, some of you might feel frustrated at that. Say, I don't understand why can't the SEC just do something and see what happens? So hopefully in showing you some of this information and the way that we use and consume information, you have a better sense of why we ask for data and why we sort of insist that in order for us to try something, we're going to have to start with something to begin with so that we know after it happens, we have an objective way of looking back and saying, was this a good idea or not a good idea? Because the one thing that we do know for sure is that whatever changes a regulator makes can have sweeping ramifications, all sorts of consequences, both intended as well as unintended. And the unintended consequences, if people say, this is bad, something bad happened, we want to be able to say, yes, but something good happened. And the question is the thing that happened that was good, is that measurable? Is that anticipated? The fear that I have is that when we go into pilots sometimes, there's not even a consensus in the industry on what we're hoping to achieve. So before any pilot is ever done, if you're measuring a number, and I don't know, order trade cancel ratio, doesn't matter, let's say it's 10, and everybody says 10 is the wrong number. This can't be 10, 10 is bad. And we do a pilot program, we make a change, and we measure it a year from now. And a year from now, the 10 went to 20. And everybody in the industry says, we're 100% certain that it was 10. Now we're 100% certain that was 20. So no one is arguing about the data. And then half the industry says, this is why the pilot was great. It went from 10 to 20. Awesome. Make it permanent. And the other half says, are you kidding me? We wanted it to go down to 5. We didn't want it to go up to 20. It was supposed to go down, not up. Those are not discussions and arguments that you have at the end of a pilot. Those are discussions that we want to have with the industry before the pilot is even conceived, so that if we're testing to see whether or not something is good or bad, we should at least know what the criteria is for either being good or bad before we start the pilot. So 30 seconds left. I'll just leave you with one final thought. Hopefully this gives you a good idea of how we're using data. And mostly, I hope I've been able to convince at least a few of you that this type of objective data analysis can inform public policy in a way that's going to make us, you, and hopefully investors a lot more confident about the market structure that we have. Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.